Quick question. Have you even ever opened your brokerage app in December, see your gains for the year, and then felt a little sick when you realized how much of that is about to go straight into the IRS? Yeah, me too. And that's exactly why we are making this video. Welcome back to Fintelliq. Today we are talking about something called tax loss harvesting. It sounds like a fancy Wall Street term, and honestly, it is kind of it. But the idea behind it is that simple, and once you understand it, you can use it too. And not just for billionaires with private bankers, anyone with a normal taxable brokerage account can do this. Wall Street even has a nickname for it, Tax Alpha. That basically means extra money in your pocket. We are not picking a better stock, not from timing the market, but simply from being smarter about how you handle your taxes. By the time this video ends, you are going to understand three things cold. Exactly how the IRS lets you use investment losses to cut your tax bill. The infamous 30-day rule that quietly trips up almost every investor at least once in their life, and the exact step-by-step playbook that professionals run before every single year end. So let's get into it. So what exactly is tax loss harvesting? Let's start from zero. No jargon. Tax loss harvesting in just even plain English means this. You sell an investment that has gone down in value on purpose so that loss becomes official in the eyes of the IRS. Here's the one word you need to remember for this entire video: realized. As long as you are just holding into a stock that's down, that loss is only a number on the screen, and it's not doing anything for you. It's what people call a paper loss. The moment you actually sell it, that loss becomes real, official, and even unusable. And now you are allowed to use it to cancel out taxable gains you made somewhere else in your portfolio this year. Now, important reality check. This doesn't erase your taxes forever like magic. What it actually does is lower the cost basis on whatever you buy next. So really, you are just pushing the tax bill into the future, but don't underestimate that. Deferring taxes is still a huge win, because that money that would have gone into the IRS instead stays invested and keep compounding for you year after year. So here's the simple 4-step loop you are seeing on screen. 1. You own something that's currently at a loss. 2. You sell it and that loss becomes realized. 3. That loss offset gains elsewhere in your account. And the 4th one, you reinvest, so you are just sitting in cash. But you have to do that carefully without breaking one every specific rule. This is exactly what we are covering the next. So before we get into the actual strategy, there's one foundational rule you absolutely need to understand, because the entire game is built on top of it. The IRS treats your gains and losses completely differently depending on how long you held that investment. So if you held something for 1 year or less, that's called short term, and the short-term gains get taxed at your ordinary income rate. Literally, the same tax brackets that tax your paycheck at the very top end. That's up to 37%. Yeah, that's brutal. That's almost 4 out of every $10 of profit going straight to taxes. But if you held that same investment for more than just 1 year, it becomes long term, and suddenly you are in a much friendlier world. 0%, 15%, 20%, depending on your income. Higher earners might also owe a small extra 3.8% net investment income tax on top, pushing the real top rate to 23.8% still. 23.8% versus 37%, that's a massive difference. So why does this matter for our strategy? Because a short-term loss is more valuable to use, since it's cancelling out income that would otherwise be taxed at that brutal 37% rate. Keep that one idea in your back pocket, because it's going to directly shape which losses you prioritize selling, which is exactly where we are headed next. The IRS netting rules, the order of operations. Okay, here's where it gets genuinely strategic. You can't just throw your losses at any gain you want. The IRS forces you to follow a very specific order of operations. Think of it like a waterfall. The losses had to flow through each step before moving to the next. The step 1 is called internal netting. Short-term losses first cancel out short-term gains, and separately, long-term losses first cancel out long-term gains. Each bucket fights within itself first. Step 2 is cross-category netting. If you still have leftover losses in one bucket after step 1, it spills over to offset the net gain in the other bucket. So a leftover short-term loss can reduce a long-term gain and vice versa. The step 3, if after all of that your losses still exceed your total gains for the year, the IRS lets you deduct up to $3,000 of extra loss directly against your regular income or salary. That's around $1,500 if you are married and filing this separately. And the step 4, the best part out of it, anything still left over doesn't just disappear, it carries forward independently into future tax years. So even though a rough year in the markets is not wasted, you can bank that loss, keep using it for years into the future. So if you actually have a choice, say you are sitting on both a short-term loss and a long-term loss and can sell only one day, which one should you pick the first? Look at it this way. A short-term loss can cancel out a gain that was going to be taxed up to 37%. The long-term loss can only cancel out a gain taxed at roughly 20 to 24%. Same size losses. Very different amount of tax you actually save. So dollar for dollar, harvesting a short-term loss to wipe out a short-term gain saves you noticeably more money than harvesting a long-term does. This is literally what professional means by tax alpha, squeezing the maximum benefit out of single dollar of loss you realize. So if you are ever deciding which position to sell first, prioritize cancelling out your highest tax gains. And alright, this next part is single most important rule in this entire video, so pay attention closely. This is the rule that trips up almost every investor at least once. It's called the wash sale rule, officially IRC Section 1091. Here's the concept in plain English. The IRS doesn't want you to fake a loss while secretly holding into the exact same investment position. So they built a 61-day danger zone around every sale. That's 30 days before you sell, the day of the sale itself, and the 30 days after. If anywhere inside that window you buy a substantially identical security or even just an option to contract to buy one, that sale gets flagged as a wash sale. And if that happens, the IRS simply disallows the loss of that tax year. You don't get to use that. Timing here is really genuinely matters. So let's say you mess it up and trigger a wash sale. What actually happens? 3 things. Once your loss is disallowed, you simply cannot deduct it from on this year's tax return. It's blocked. Full stop. Second, that loss doesn't just vanish into thin air, it gets added onto the cost basis of your new replacement shares, so you will eventually benefit from it, just much better than you planned. 3. Your holding period carries over from the old shares to the new ones, so at least you don't lose your long-term status if you already had it. But here's now the trap that catches even experienced, sophisticated investors off guard. This rule applies across every single account you and your spouse own. So, taxable brokerage, IRA, 401k, all of it. So, if you sell a stock at a loss in your regular brokerage account and then buy it back inside your IRA within that same 30-day window, you have still triggered a wash sale. And because IRS don't track cost basis at all, that loss isn't deferred like normal. It is gone permanently. This is one of the most under-discussed traps in personal finance. So please double check your IRA and 401k trades, not just your regular account. Okay, so here's the natural next question. How do you actually harvest a loss without just sitting in a cash for a month, missing out on potential rally? This is where the real skill comes in. Using smart replacement strategies. Strategy 1 is the ETF replacement model. Say you sell a Vanguard S&P 500 ETF, ticker VOO, at a loss. Your first instinct might be, great, I will buy iShares for S&P 500, ticker IVV. Instead, be careful. 2 funds tracking the exact same underlying index could be viewed by the IRS as substantially identical, which risks a wash sale. The safer move is to buy something that tracks a fundamentally different index instead, like the VTI, the total stock market ETF, or a dividend-focused fund like SCHD. You stay fully invested into the market, just not in an identical fund. And the strategy B, that's the second strategy, is for individual stocks. Essentially, as direct indexing style swap. Say you own a Chevron and it's down, you sell it and immediately buy a close industry peer like ExxonMobil. Same sector, very similar exposure to oil and energy prices, but legally two completely different companies. No wash sale. Now, sometimes you don't want to substitute stock at all. You say love Apple. You want to keep your next Apple position. No swapping to some other tech company. That's where strategy C comes in. The 31-day double up method. Step 1 to this. You buy a second block of that same stock today, effectively doubling your position size. Step 2. You simply wait 31 consecutive days. Just one day past the wash sale window. Step 3. After that month has passed, you sell your original older lot at a loss. Because that new block was purchased outside the 30-day window surrounding your eventual sale, the loss is completely valid and you never actually left your position in the stock the whole time. It's a very clever move and it just requires some patience and temporarily some extra capital to fund that double position. So let's pull everything together into a practical checklist you can actually run though before the 31st December. 1. Review your cost basis lot selection. Most brokers default into the FIFO, first in first out, but you actually want to switch to specific identification or spec ID so you can handpick your highest cost, most loss generating shares to sell first. 2. Audit your dividend reinvestment settings. If auto drip is turned on, a dividend would get automatically reinvested during your 30-day window and accidentally trigger a wash sale without you even realizing it. Turning off ahead of time on anything you are planning to harvest. Step 3. The third one. If you hold crypto, stay alert. Digital asset wash sale rules and the IRS reporting requirements have been evolving, so don't assume the old rules will apply forever. Be secure about that. And the fourth one, watch out for mutual funds distributing capital gains near year end. So if you buy into a fund right before its distribution date, you could end up owing tax on gain you never actually benefit from. It's sometimes called a phantom gap and it's completely avoidable if you just check the calendar first. So let's wrap this up. Tax loss harvesting is genuinely one of the few pre-launches available in investing. Done correctly, it can meaningfully boost your after-tax returns without changing your actual risk exposure in the market at all. But remember, wash sale rule is very much strict. It applies across every single account you and your spouse own, and mistakes here can permanently cost you a valuable deduction, and especially inside an IRA. Plan your lot selection carefully, mind that 61-day window, and use the replacement securities not fully. Quick disclosure before you go, this video is for educational and informational purposes only. It is not formal tax, legal or financial advice. US tax code changes, so always talk to a qualified CPA or tax attorney before executing any year-end tax credits. So if this video made talk tax season feel just a little easy, scary, do me a favor and hit the subscribe button. Fintelliq breaks down institutional grade money strategy in plain English every single week. Thanks so much for watching and I will see you in the next one. Till then, bye.